89 companies reported this week, and anyone hoping for any signs of an improving housing market was sorely disappointed. It is not a great time to be a home builder. Molina is a managed care company, reported Wednesday night. The results were awful. Clearly, the entire managed care space is having problems everywhere. Now, both GEV and GE have done very well this year, with both up around 80% this year alone. As the results of GEV and Amphenol show, almost anything related to AI is doing well. But for the rest of the economy, it is more mixed and nuanced. So let's take them one at a time. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending October 24th, 2025. This week, the market didn't do very much, and the market continues to churn near all-time highs. But the week began with some nice news for Apple. Apple's sales of its new iPhone 17 are doing quite well, up around 14% versus the 16. And as a result of that news, Apple reached an all-time high on Monday and now has a market cap just below $4 trillion, and only Nvidia has a bigger market cap. But despite the rally, Apple is up only 6% for the year and still trails the market and most of the Mag 7. The market still really wants clarity on Apple's AI or lack of an AI strategy. Moving on to earnings season. 89 companies reported this week. And I will, of course, thank God, not go through all 89. Just the important companies and big themes. Over the past several weeks, I've been commenting that we are experiencing something of a K-shaped economy. Everything related to AI is great and growing, but the rest of the US economy is very mixed. So I'm going to divide the companies into two major groups: AI and AI-related, and everything else. In the AI and AI-related companies, there were two major reports: GE Vernova and Amphenol, and both reported powerful results. GE Vernova. So who is GE Vernova? It's the old GE split into three companies: GE Healthcare, GE Vernova, the symbol is GEV, and GE Aviation got the old symbol GE. Now both GEV and GE have done very well this year, with both up around 80% this year alone. Now, GEV is an AI-related company. Its major business is that it builds gas turbines for utilities. In other words, it is part of the story of supplying the absolutely insatiable demand for electricity because of AI. However, I need to point out that building gas turbines takes time. Orders today are delivered actually a few years from now. So this is not a company that will all of a sudden blow out earnings when it reports. The key thing to look at here is backlog. So GEV reported, and it earned $1.64 per share versus 35 cents last year, but that actually was a miss versus the estimate of $1.86. And that miss was why the stock was down for most of Wednesday. But it did rally back and ended down only 1.5% on the day. But under the hood, everything was good. Total revenue was almost $10 billion, which is up 12% year over year, and was a beat. But again, the key is the backlog, or total orders, which reached almost $15 billion and was up 55% year over year. That backlog is key, and it is very strong, and that is what investors pay attention to. Moving on to Amphenol. In some ways, the change in the dynamics of Amphenol's earnings is a showcase for the power of AI. Amphenol makes all the connectors required to connect technology. It was never the most exciting tech story, just a necessary one with great management and with always steady Eddie results. In fact, there have been plenty of times when Amphenol was viewed by tech investors as a safety stock within the tech sector. Prior to AI, Amphenol's earnings would grow around 20% per year. But because of the explosion in data centers, Amphenol's earnings have been turbocharged. Take the results for the third quarter that the company just reported. Third quarter sales grew, get this, 53% in total and 41% organically. EPS beat by a lot and grew 87% year over year. This is not your old steady Eddie Amphenol anymore. As the results of GEV and Amphenol show, almost anything related to AI is doing well. But for the rest of the economy, it is more mixed and nuanced. So let's take them one at a time. First, we'll turn to housing. Pulte Home. Now, housing is certainly a part of the economy that is moribund. And that thought was reinforced when Pulte reported. Now, Pulte is the third largest home builder by market cap at around $24 billion. And anyone hoping for any signs of an improving housing market was sorely disappointed, as Pulte missed on almost every metric. The company reported $2.96 in EPS, which was down versus last year at $3.35. Home closings fell 5%. Home sale revenue fell 2%. And net new orders fell 6%. All in all, pretty ugly numbers. The only positive sign lately is that mortgage rates have recently fallen. And lest you think Pulte is alone in having problems in the home building sector, NVR, an excellent but more of a regional home builder, also reported weak results with revenue down 4% and earnings per share down 14%, and new orders were down 16%. It is not a great time to be a home builder. Now, although rates have come down recently, and that will help, they are still too high, and the entire country has an affordability problem. The affordability problem is largely, I think, an issue of prohibitive local regulations which make it too hard to build affordable housing. This is a problem that should be tackled by the federal government, whereby local regulations would be overruled, but no one at that federal level really wants to tackle the problem. Moving on, General Motors. On the positive front, GM results were quite a bit better than expected, and so was guidance. The company had better than expected pickup truck sales, its highest margin product, and noted fresh relief from the Trump administration's tariffs on auto parts. And guidance went up quite a bit. General Motors likes to guide to earnings before interest and taxes, and for 2025, it now guides to $12 to $13 billion, up from the prior guidance of $10 to $12.5 billion. On this news, GM's stock soared 15%. One more point. GM's 2025 PE is 6 times. Tesla's 2025 PE is 255 times. I'll say that again. GM's 2025 PE is 6 times, and Tesla's 2025 PE is 255 times. Conclusion? Tesla's PE has absolutely nothing to do with its current auto manufacturing business, but with all the stuff, AI and robotaxis, that the market hopes Tesla will produce. And speaking of Tesla, Tesla reported this week. There were some positives, but I'd have to say, really not many. On the positive front, revenue rose 6% for the quarter, as opposed to falling 16% as it did in the second quarter. But the reason for the increase in revenue was the boost of Americans rushing to buy electric vehicles before the $7,500 federal tax credit expired on September 30th. And on the call, Musk admitted as such, and he gave zero guidance for auto sales in the December quarter. How could he? Also, the improved sales did not translate into decent profits. Tesla's net income fell 37% versus last year to only $1.4 billion, and that was worse than expectations, despite the beat in revenue. Now, of course, the Tesla bulls don't care, because they no longer care about the straight auto business. Musk is focused on 2 major bets, robotaxis and the Optimus humanoid robot. But even here, Musk seemed to walk back the targets for both of these projects. In robotaxis, he said that Tesla aims to launch service in 8 to 10 metro areas by year end. And that sounds like a retreat from comments he made on the last earnings call, where he said the robotaxi biz would reach half the population in 2025. And with respect to robots, Musk said he hopes to start production by the end of 2026. But he had been aiming to produce 5,000 in 2025 and 50,000 in 2026. Apparently, Tesla is having some trouble perfecting the robot hands. Anyway, All this is in the future. The bulls will continue to believe, and the bears will continue to scratch their heads. Moving on, Equifax, which is a fintech company. It reported earnings. It beat earnings and raised guidance, but that's not why I bring it up. This is a company I have not spoken about before. Like I said, it's in the fintech space. It's a very good company that operates behind the scenes. It has several good businesses, but its most famous business is that it operates a credit bureau. What's a credit bureau, you ask? Well, every time you make a credit card payment or a mortgage payment or pay any kind of consumer debt, that payment gets reported to all three credit bureaus, which are Equifax, Experian, and TransUnion. Now, if you are late on a payment, that gets reported too. And if you are delinquent on your mortgage, that gets reported. So when you apply for a new mortgage loan or a new credit card or any kind of consumer credit, the lender goes to Fair Isaac, otherwise called FICO, and FICO generates a score called the FICO score. And that is your consumer credit score, and it is the major determinant as to whether you will get any kind of consumer loan. Now, to create its FICO score, Fair Isaac pulls data from the credit bureaus. So the credit bureaus are the data that generates the score, but FICO creates the score. Now, FICO has basically a monopoly on this business, especially in mortgage. But lately, that is starting to change. A few months ago, the head of the FHFA, which is the agency that regulates Fannie Mae and Freddie Mac, announced that it was requiring mortgage companies to get away from just using FICO, but require them also to use VantageScore, which is created by the credit bureaus. In response, FICO announced a new product at a much lower price, and the credit bureaus are striking back with their own lower price scores. A price war has begun, which is great for the consumer. I raise this because I find FICO's strategy here very odd. It's one thing to engage in a price war with your competition. It's another to engage in a price war with three companies that are your suppliers. This is an unfolding story, and I'm sure I'll have more to say about it in the future. Now, while the growth in the US economy is largely AI and AI related, there are pockets of strength elsewhere. Take aviation. GE Aerospace, which I mentioned before, reported, and the numbers were excellent. With respect to GE, the company manufactures and services jet engines. Now, we are going through a period where airlines are upgrading their fleets, and so GE's results were strong across the board. It beat on earnings and revenue and raised guidance. Everything points to the fact that this aviation upgrade cycle continues. Moving on to Netflix. The stock was down high single digits on Wednesday after it reported for two reasons. First, earnings actually missed. The company reported earnings per share of $5.87 versus $5.40, which was actually quite a large miss, but was because of a one-time tax dispute in Brazil. I think more importantly, revenue reached $11.5 billion, which was up 17% year over year. And that's impressive. But that number only matched Wall Street estimates. And when your PE is 35 times next year, Wall Street needs to see a revenue beat. There is nothing wrong with Netflix. It is still the king of media. It just did not beat expectations. T-Mobile. Sometimes it's just impossible to know how the market reacts to earnings. T-Mobile's results were quite good, but the stock went down on Thursday anyway when the company reported. It slightly beat on earnings and revenue, but most importantly, it added a net 1 million post-paid customers. And those are the best customers, the ones that pay at the end of every month. That 1 million was the best third quarter number in over a decade, and by far the best in the industry. So T-Mobile's model continues. And what is that model? I've discussed this before. It's the model used by Walmart, Costco, and Progressive in mature industries. Be the low-cost provider, pass on those efficiencies to consumers, and keep taking market share. The last company I want to address is in the managed healthcare space. About a month ago, I dropped an interview with Michael Ha, a managed care analyst, and we discussed United Healthcare and his opinion that its problems are a combination of rising healthcare costs coupled with Medicare reimbursement issues. UNH is having a hard time. The estimate for UNH for 2025 at the beginning of 2025 was $30 and is now $16. Well, it looks like there are issues out there that go beyond just Medicare. Molina, which is a company I want to discuss, reported Wednesday night. Now, Molina is a managed care company that focuses not on Medicare, but on Medicaid and health exchanges, aka Obamacare. The results were awful. The company's results missed by a mile. They reported $1.84 versus $3.90, driven by much higher medical costs in the healthcare exchanges. Now, other managed care companies are having medical cost issues in the exchanges as well. Molina reduced 2025 earnings per share guidance by 26% and expects 2026 to only equal the now revised lower 2025 guidance. Ugly. On this news, Molina went down 20% and is down around 47% for the year. Clearly, the entire managed care space is having problems everywhere, and I'm sure we will be addressing these issues in the future. Before we end, I just want to address one quick question I got from a viewer. On last week's wrap, I mostly focused on bank earnings results, and I said that my conclusion about credit quality came from the reams of data disclosed by the banks. One viewer asked, quote, "Where can you review these reams of data from the banks?" Good question. If you want to look yourself, I would go to the investor relations websites of the major banks, JP Morgan, Wells Fargo, PNC, Bank of America, and Citi. Pull the press releases and read those quickly, but then download the earnings supplements of each company. It's in the supplements that you will find a wealth of data. No need to go to Goldman Sachs and Morgan Stanley, as they make few loans and don't disclose much about them anyway. And that's the wrap. This week, we dropped 2 interviews. The first was with Craig Moffett and Michael Nathanson of Moffett-Nathanson, one of my favorite research boutiques. Our discussion ranged from Apple's lack of an AI strategy to why cable stocks are such a disaster, to the demise of traditional ad agencies, to the rise of youth unemployment because of AI, to the need for streaming consolidation, and why Verizon suddenly fired its CEO. On Wednesday, we also dropped a bonus episode with Nick Del Deo, also of Moffett-Nathanson. Nick covers the data center space, digital realty, Equinix, and CoreWeave. We had a great discussion about data centers and their incredible growth, so check it out. This Monday, we will drop an interview with Andrew Sorkin, and the topic is his new book entitled 1929, which is, of course, about the crash of 1929. And we also touched upon the parallels between 1929 and the great financial crisis. Fun fact, October 24th, Friday, 96 years ago, was the beginning of the crash of 1929. It started on October 24th and culminated on October 29th, 1929. So I hope you tune in to the Andrew Sorkin interview. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes, as well as the financial literacy masterclasses and some other goodies we will be posting soon. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.